Hey everybody, it's Clayton come back with another episode. This video is going to strictly focus on the stocks that I hold, how I view them, the safety of these stocks moving forward through this market that's been all over the place. It's up, down, obviously you guys have seen over the last week or so, week and a half now. But I'm going to dive into each one of my stocks that I hold with also Simply Safe Dividends, go over their safety score, what they give it, and kind of how I feel about each of these stocks going forward. As you've seen or probably have noticed, I haven't posted a video in about a week and a half, just kind of getting everything going when it comes to what's going on right now with the family and just taking care of everything. And the last week and a half, the market shot itself back up. And I'm never one to try to play the market and say what's going on. I go over this all the time: dollar cost averaging, dollar cost averaging, dollar cost averaging, and I'm going to continue to say that. Also, I wanted to point out, in case the audio seems a little off today, I'm having to film in a new location, just again for situational purposes. It'll be going back to normal. If you like how this audio sounds more than the other, let me know. I love feedback, and I could make this my new location to record, but right now it's just a temporary. But like I said, I'm going to dive into my holdings, and for anyone that hasn't been following my videos or my accounts, these are what I hold. Right now I've got IBM, 3M, AT&T, Wells Fargo, JP Morgan. You can see the list. But for those that are kind of listening in the background, we got Walgreens, Reality Income Corp, SPHD, Coke, Target, Disney, Carnival Cruise Lines, Verizon Wireless. We've got a few bonds, Delta, and Pepsi. Obviously, before we even start into safety, I already know that both Delta and Carnival have cut their dividends completely. So there's no shock coming there. And we'll see what the future holds for them. I still think that Carnival is a decent hold for now. I'm not really going to be putting any more money into this. I've gone over this in past videos, but I'm not selling them. I think they'll rebound pretty nicely. And same with Delta. Delta, I don't think there's a problem. I'm going to invest in them a little bit more. I've lowered them in my portfolio. Let me show you. Go back to the portfolio. I've lowered investing right now into them. It's literally 1% of my portfolio. I've dropped it down. It was only 2% before. So I don't mind putting a little bit of money in it, but it's definitely not a focus of mine. Because who knows how long it's going to be. Who knows how long it's going to be till dividends are back with Delta, with this basically bailout that they're getting, and with the policies we went over, the stipulations with this money. It could be a while till they come out of this and are able to pay dividends if they ever do again. But I don't feel that they need to be selling or to sell their stock currently. So like I said, I'm going to dive into Simply Safe Dividends. I'm going to use them. I'm not a sponsor. I'm not affiliated with them at all. I'm actually just using their 14-day free trial. And I really like the site. I'm debating going forward and maybe signing up for it, but we'll see. That's my own personal choice with that, obviously. But if you've never tried it, it's a 14-day free trial. They don't ask for any information. And they give pretty good data, and they basically condense everything from around the web and any news articles about it. So I'd recommend it personally. But again, not a sponsor. And everything I'm going to talk about in this video is simply my opinion. I am not a financial advisor. Please do not take my advice as financial advice. Use my advice if you'd like to do your own research before you invest in anything. Just want to say that off the bat. So let's dive in. And you're going to see there's a safety score system that they give each of their investments. And for each one, I'm going to break down and go into specifically what I feel and how I feel about this company going forward. So we'll see Wells Fargo right now. When you look at Wells Fargo, they've got a 55 when it comes to safety score. And on their site, they even address that anything 60 or lower is deemed as borderline safe. And you could even potentially, it's not that you need to expect that a cut's coming, but they essentially don't know what's going to happen with these companies. So that's why they put them in that tier. Wells Fargo is 55, Disney 60, and JP Morgan. Those three are the borderline safe ones. And there's one other that they don't have as borderline safety for me, and that is Walgreens. But I'll address that when we get to it. So let's look at each one of these. So when we start with Wells Fargo, dividend safety score. Right now, they were paying an earnings payout ratio of 43%. But when you look at the projection, it looks like over the next 12 months, they're expected to pay out 70%. That's if they don't cut their dividends, and they pay as they were. And that's where I think Wells Fargo and Chase falls into the same kind of category. I think they will be cutting theirs, but we'll see. I'm not jumping off ship with Wells Fargo or Chase. I think both of them, to me, are companies that are good for the long haul, and they're going to experience some bumps in the road now, but I truly think that they'll be fine. They don't really have much that worries me with them. The only real thing is obviously the yield, but their PE ratio is still good, so their price to earnings ratio is still good. I'm just curious to see, because of how low the stock has fallen and what's going on with that company and that bank, where they stand. And JP Morgan is kind of in the exact same boat for me. They're only going to about 50%. They'll be projected about 51% of their earnings pay ratio. Again, these are just projections. They're using just different bits of information that they have. And the earnings per share obviously drops to $7. But I don't know. The two banks, those ones, I'm kind of on the fence on for both of them. The PE ratio didn't get affected much. They're just above their average. Now, we'll see, obviously, with those two. One I do think that will cut, and this is what I wanted to kind of talk about a little bit, is Disney. Disney, as you see, was only paying about 32% of their earning payout ratio. And with that being said, it's projected 62%. And Disney, though they care about their shareholders, and that's usually where most of their concern tends to go as someone that lives in the Florida area and has been following Disney basically my entire life, the first thing that comes with them usually is their shareholders and stockholders, and especially the CEO that just took over. I'm blanking on his name, but he has made it clear that that is important to him. And I think personally that they will continue to pay out their dividends because they care so much for the shareholders, and that they will take some of the funding that was being used elsewhere, and that'll be scrapped, be it for park upgrades, cruise ship upgrades, maybe, I wouldn't really say film, but possibly with some films have been scrapped, or TV shows like for Disney Plus, because they just passed the 50 million subscriber base, which they thought they'd hit. I think it was 2023, 2024 was their goal. And because of what's going on, they've already surpassed 50 million subscribers. So Disney, to me, I can possibly see cutting their dividends. If this was Disney of the past, I would say yes. But from what we've seen and what I've heard from the new CEO, it's kind of up in the air for me. And I won't be shocked if they do cut it. Again, Disney to me is a company that will easily bounce back once this is all said and done in a few years. It may take a few years for them to bounce back, because who wants to go to a theme park and be shoulder to shoulder with somebody standing side by side? It doesn't really bother me to do that, but I'm not the general population. So we'll see once the parks open back up how they do. But Disney's another one that they've got ranked as a 60% or 60 on the borderline, as well, like I said, JP Morgan. So I won't be shocked if they cut it at all, but they're just one I really like. So now I'm going to get into the ones that they deem as likely safe, or extremely safe. And the first one I want to talk about, the rest of them don't worry me, and that's why I've kind of focused on Walgreens first. I want to talk about Walgreens. They've got them at a 79. And I understand completely why they do have them at a 79. So the first thing I want to focus on, you'll see right here, they've got a lot of debt on their books. Walgreens does. But the advantage for Walgreens is what's going on right now in the world. Advantage isn't the right word, but the benefit, however you want to say it, Walgreens isn't being as affected as much as other industries are with this, because of they sell the medication. They are essentially a quick shop store where it's just pick up necessities, and really their medical supplies, I think, can help carry them through this as a store and as a retailer. So as you can see, like, their earnings per payout ratio isn't expected to go up very much. And their PE ratio, if I remember correctly, also isn't expected to bump very much. Yeah, if you look at the PE ratio, it's actually supposed to be below the 5-year average. So we'll see. Walgreens, I think if it was anything else besides this specific situation that's going on, and Walgreens were to have lost money like they are, they would be cutting without question. I think they'd be not even in the questionably safe. What was the exact terminology? Borderline safe. I think they would easily cut just because of the loans they have. But the economy, I think, will help them when it comes comparing to other industries, and I think they'll be perfectly fine. Now, the other ones I want to dive into is IBM. IBM has been one that I think was the first video I ever made. I praised IBM about the additions they made and some changes they made internally. And Simply Safe has them at 65. I would agree with that. It doesn't look like their earnings per payout ratio is expected to go up very much. 6% is the projection. Earnings per share is less than $1. Their PE ratio is also pretty good still. And that's actually what you're going to see through the rest of these. The PE ratio is expected, it's around the 5-year average. Some are lower, some are a little bit higher. And the earnings per payout ratio and the earnings per share are essentially where they've always been. Down a little bit from the years prior, but not much. And that's why I think Simply Safe, as well as myself, deem these as safe companies. And I'm just going to go through the numbers now. I'm going to keep these, as you'll see in this video, as I speak about each company, it's going to have its safety score in the corner. But for as I'm doing this, we got AT&T's at 65, Target's at 74, 3M's at a 75, Walgreens, like we talked about, 79. I think it's because of what's going on that they're not going to cut their dividends anytime soon, in my opinion. Coca-Cola, Realty Income Corp, Verizon, and PepsiCo. Oh, sorry, let's go down that again. Coca-Cola's at an 80, Realty Income Corp's at 86, Verizon's at an 87, and PepsiCo is at 93, which I don't think I talked about in my last video. I know I talked about Verizon a little bit, but Pepsi's also a company that I picked up during this situation. Pepsi's stocks haven't really changed all that much, but I've been interested in Pepsi for a while. I've already owned Coke. Figured why not own the competition, as the easiest way to put it. And I've got a little bit invested in Pepsi. If you look at my portfolio and my activity, I'll go back to morning trades. This was on the 9th, so about a week ago. I got $10 worth of Pepsi. Nothing crazy. It's less than, not even like a quarter of a share, not even a tenth of a share. But I'm going to put a little money into Pepsi and see where it goes. So like I was talking about before, kind of all over the place now. Sorry, it's been a little bit since I filmed. IBM, another one that I said I think will be good. AT&T, they're actually lower than their average has been for the earning payout ratio. So for them, I don't think there's any chance they cut it. They're lower than they've been for the last few years. And obviously I know situations have changed and with the purchasing of HBO. But I think they're completely safe, in my opinion. Same with Target. Target's projection is just about where their earnings payout ratio usually is. Earnings per share is going to go up a little bit. 3M, they are expected to pay out a little bit more. They've been paying out more than than most companies at 65 for the last 2 years. And they're probably going to hit, I think, 70, maybe even 74, 75%. But 3M's just been doing this for so long when it comes to dividends. I don't think they cut it through this. They've got enough when it comes to their publicity hasn't been great for them, but with the making of masks and the products they make, I think they'll be okay through this. So they're one I'm not worried about. And then, like I said, Coke, they're projected at earnings pay ratio of 81. They have gone up dramatically over the last decade, but I think Coke is still safe. I know that seems redundant when it comes to they're projected to be at 81% of their payout ratio. But with Coca-Cola, they're just one that their debt looks fine, and they've been doing dividends for 25 years, and I just don't see them selling anytime or cutting their dividends anytime soon. Realty Income Corp, if anyone that doesn't hold a REIT, REITs essentially are stocks that have to pay out a specific amount, and they don't have to pay taxes towards that. So with that, Simply Safe, Realty Income Corp for me is a lock. Like I said, it's just advice. But because of them being a REIT, they've got less cushion to pay their dividends so if anything were to happen. But with what's going on right now, I don't really see Realty Income Corp suffering that much. Obviously, all of this could change. Something could change today or tomorrow that drastically changes every investment I have, and everybody could come at risk, or everybody that's safe could be completely to lose their dividends. There's no way to project the future. I'm simply taking a snapshot of what I see today. Today's the 15th. And what I feel for the future. Verizon, again, talked about them last video. To me, they're really safe. I don't have any worries with Verizon. And then finally, Pepsi. But yeah, I wanted that to be the gist of my video. I wanted to kind of go over each of my stocks. People are asking me how I feel with what I hold, how I feel other stocks will do. And for me, these are the stocks I hold. Obviously, I'm going to still probably add some more to my portfolio. I'm looking through to see what stocks are on sale. The market's all over the place, as always. And we'll see what happens and what becomes available and what maybe I want to put more money into. But for now, I'm really liking my portfolio. I am down $486 will be, I told you before, the gains mean, I always say nothing means it's not nothing. It's still money it's still money to me that I could obviously, I've lost $486. But in the end, I don't think it means much to me because all of these that I'm holding will bounce back. There's no question to me that in this time next year, I don't know how quickly it'll change, but this time next year, I'm pretty sure everything I own that gains will be back into the green. It may be way sooner than next year, but nobody can predict what's happening. We hear that the economy might be opening up next month. We hear that you have to wait 18 months for the vaccine. It's all over the place. But all I know is while I sit back and while most of my companies still remain to pay their dividends, my dividends are just slowly increasing. I'm slowly putting in my $150 every month or $125 every 2 weeks like I've said I was doing. And I'm just going to keep that going, dollar cost averaging. But thank you for made it this long. I know it's been a long, rambling video. I hope you're able to get something from it. If not, I apologize. If you have any questions, as I always say, leave them in the comments or email me at claytonscash89@gmail.com. That's ClaytonsCash89@gmail.com. And I look forward to talking to you guys soon, and have a good evening.